Mastering Bookkeeping Basics Financial Statements. What are financial statements? Financial statements are summary accounting reports prepared periodically to inform the owner, creditors, and other interested parties as to the financial condition and operating results of the business. The four basic financial statements or reports are: balance sheet. The financial statement which shows the amount and nature of business's assets, liabilities, and owner's equity as of a specific point in time. It is also known as a statement of financial position or a statement of financial condition. Income statement. The financial statement that summarizes revenues and expenses for a specific period of time, usually a month or a year. This statement is also called a profit and loss statement or an operating statement. Capital statement. The financial report that summarizes all the changes in owner's equity that occurred during a specific period. Cash flow statement. The financial statement that reports the sources and uses of cash for a specific period of time, normally a year. Order of preparation. Because some of the statements use information from other statements, the statements are prepared in the following order. 1. Income statement revenue minus expenses equals net income or profit. 2. Capital statement uses information from the income statement. 3. Balance sheet uses information from the capital statement to update the owner's equity section. 4. Cash flow statement uses information from the balance sheet. Additional explanations. Income statement. The income statement is a formal financial statement that summarizes a company's operations revenues and expenses, or a specific period of time, usually a month or a year. The categories and formats of the income statement follow the rules known as generally accepted accounting principles and contain specific revenue and expense categories. Types of income statements. Single-step income statement. A single-step income statement is the income statement format where all the revenues and gains are grouped together and totaled, and all the expenses are grouped together and totaled. Net income is then calculated by subtracting the total expenses from the total revenues. Multi-step income statement businesses that are retailers, wholesalers, or manufacturers that sell products have a special section included in their income statement called cost of goods sold. This section computes the cost of the goods sold that were either purchased and sold or manufactured and sold. These types of businesses would normally use an alternative to the single-step income statement format called the multiple-step income statement because it uses multiple subtractions in computing the net income shown on the bottom line. The multiple-step profit and loss statement segregates the operating revenues and operating expenses from the non-operating revenues, non-operating expenses, gains, and losses. The multiple-step income statement also shows the gross profit net sales minus the cost of goods sold. Capital statement. The capital statement serves as the bridge between the income statement and balance sheet. It uses the net income loss from the income statement, in addition to the owner's investments and withdrawal, to determine the owner's ending capital balance shown on the balance sheet. Balance sheet. A balance sheet is simply a picture of a business at a specific point in time, usually the end of the month or year. By analyzing and reviewing this financial statement, the current financial health of a business can be determined. The balance sheet is derived from our accounting equation and is a formal representation of our equation assets equal liabilities plus owner's equity. If you recall, in an earlier session we learned that this equation is also called the balance sheet equation. The categories and format of the balance sheet are based on what are called generally accepted accounting principles. These principles are the rules established so that every business prepares their financial statements the same way. Balance sheet formats. The account form presents the major categories side by side. Another layout sometimes used is called the report form. In this form, the major categories are stacked on top of each other. Cash flow statement. The last financial statement The cash flow statement is prepared to report all the changes in cash that occurred over a period of time, usually a month or year. If the business was in operation in the previous year, the prior year balance sheet along with the current year balance sheet and current year income statement is needed in order to prepare the statement. Additional analysis of some of the accounts may also be needed. Notes to financial statements. Notes to the financial statements are an integral part of the statements and are required by generally accepted accounting principles. Notes to financial statements, sometimes referred to as footnotes, are used to provide additional information about a business's financial condition and methods used at arriving at the amounts presented in the financial statements. That finishes financial statements. See you next session.